Good morning, and welcome to the EPG webinar hosted by Kolibri Global Energy. This event is being recorded. During the presentation, all participants will be muted. If you have any questions you would like to ask, please type them into the chat feature. We will read and answer questions at the end of the presentation. Thank you so much for joining us today. Now here's Dan Steffens, who will introduce today's speaker.
Good morning, everybody, and thanks for joining us today. I'm really excited to bring Kolibri Global Energy to your attention. It looks like a very promising company. It's based in Thousand Oaks, California, with their current oil and gas assets are all in central Oklahoma's Scoop play, which I know a lot of you guys are familiar with. That's where Continental Resources put together the Scoop play in that definition. The company has been profitable in 2022 and reported production of 1,702 BOE per day in Q3, which was a big increase year over year. And they have 3 more high rate horizontal wells being completed in Q4. So the company should report a strong finish to 2022. It has plenty of operating cash flow to fund their 2023 drilling program. So the company's stock is traded on the TSX as KEI, and the US market on the OTCQX as KGEIF. Our speaker today is the company's CEO, Wolf Regener, and Wolf brings over 33 years of management experience as well as conventional, unconventional E&P industry experience to the company. Prior to joining Kolibri, he served as Executive Vice President of Bankers Petroleum Limited and was president of its wholly owned U.S. subsidiary, BNK Petroleum, Inc., that was spun off in 2008 and eventually turned into Kolibri Global Energy. Anyway, with an extensive operations and finance background, he has been at the forefront of BNK Petroleum's acquisition of unconventional gas projects on an international scale and development of the company's Tishomingo field in central Oklahoma, which is just to the west of Oklahoma City. He holds an economics degree with an emphasis on computer science from the University of California, Santa Barbara, and has served on the board of directors of the California Independent Petroleum Association for 25 years. So with that, I will turn it over to Wolf, and also Gary Johnson, the company's VP and CFO, is going to be one of the panelists to answer any financial questions. So go ahead, take it away, Wolf.
All right, thank you. Appreciate the introduction, and thanks everyone for joining. I think you'll see we'll have a pretty simple story here, and hopefully that you like. My goal today is to demonstrate to you that Kolibri is a good, solid company, excellent asset. We have a good balance sheet and cash flow that is growing rapidly. And I'll also show you why we feel we're currently undervalued compared to our peers, and the steps we're taking to rectify that undervalued situation. When looking through the slides here, you'll see that we have some forward-looking information in the presentation. You can read later on slides 2, and we have a couple of pages of disclaimers followed with non-GAAP disclosure measures that I'm sure you see from other oil and gas companies regularly. Management team, I won't go into mine too much just because of that great introduction. So lots of years in the oil and gas experience and the industry, I should say, doing a lot of different varied things. Gary Johnson, 30 years of accounting and finance experience, including directors of technical accounting for Occidental Petroleum. And both Greg, our engineer, and Alan Hemme, our senior geologist, have been with us quite a long time and helping us to optimize our completions out here in our drilling. And so our wells have gotten better and better as we've gone, and that's been a big part of what they've been doing and helping with us. Our board of directors, what I'd like to say is we have a well-rounded board with good varied experience. We have capital markets experience with David as well as Evan, accounting and audit experience with Eric Brown, who's head of our audit committee, reservoir and economic evaluation experience with Leslie O'Connor, who ran both Sproul and MHA's Denver office for a lot of years. And Evan, who came on more recently, also adds some risk evaluation experience due to his years of work in the high yield and leverage loan markets. So I won't go into this too much. I'll flip through this, but what distinguishes us is, you'll see up here in the upper right-hand corner, our proved reserves. At the end of last year, we're about 10% proved developed producing. 90% was proved undeveloped. And as I go through the presentation, hopefully you'll see why we feel that they're low risk reserves that will be translating into PDPs quite easily, and that we'll do that with our existing cash flow. Where are we? As we mentioned, we are in Oklahoma. We're about halfway between Oklahoma City and Dallas, just outside of Ardmore. And you'll see down here, hopefully you can see my pointer, where our Tishomingo field is. All around us is Exxon. And what happened out here was, originally we drilled wells for the Woodford Shale, which is about 350 feet below the Caney. So the Caney sits on top of the Woodford Shale. The Woodford was about 80% gas, and the balance was natural gas liquids and oil. And now the Caney, where we're drilling right now, is about 80% oil, and the balance being natural gas and natural gas liquids. So Exxon has bought about 280,000 acres in this field. We ended up selling them our rights to our Woodford. We actually retained just the Caney rights. They have the other rights for $147 million in 2013, when we had about 12,500 acres out here. We're now up to 17,000 acres. And we were the last holdout of them purchasing this contiguous acreage position. We are the only ones that held on to any other formations out here, just because they did want it, and we felt there was a lot of value in the Caney, which we're obviously proving up right now, that they didn't want to pay for back in those days. So that's the history, kind of where we were out here. Where we are right now, our production is about 74% oil. In contrast to the 80% I was just talking about, there's one section of the field where we have a few wells that are in upthrown horse block, where the Woodford gas has migrated up into the Caney, and it's a little gassier, and that's why it's not up in the 80% range. Growth that we were speaking to last year, we were at 6.6 million in adjusted funds flow, which is basically the equivalent of adjusted EBITDA. This year, our projections are between 23 and 25 million of adjusted funds flow or adjusted EBITDA. That's why I have the 24 million up here for the year forecast. As mentioned, third quarter, we were about 1,700 BOE a day. Our forecast exit rate for the end of this year is about 2,700 BOE a day. And we put these forecasts together in late first quarter, early second quarter. So our proved reserves at the end of last year, so it doesn't include any of the wells we've drilled this year, was $360 million. And keep in mind, that was at a reserve price for the first 6 years forward oil prices of $68 to $72. So obviously less than where we are right now, what gives us that $360 million number. Netherland Sewell does our reserve engineering. Proved and probable number was closer to about 500 million. And market cap wise, we're trading in the US, we're a little above this right now, call it $100 million. So we've got a long ways to go to catch up just to our proved reserves, which I'll also show you should be growing as well. Just before I go off this slide, you'll see Continental, where they're drilling up here in this region, since that was mentioned before. Capitalization, as I mentioned, 92 million US. Net debt, we have 16 million outstanding with the Bank of Oklahoma. And we had about 5 million in cash at the end of the quarter that we're using to drill wells right now, or complete wells. We had drilled 2 wells earlier this year, and 3 wells are in process right now. So mentioned our 2,700 BOE a day exit rate. It's going to take a 31 million of CapEx for the year. And because we're not increasing our debt size from 15 to 17 million as the range expected at the year end, our debt to EBITDA is less than 1. And Bank of Oklahoma, our line of credit there, we have 25 million on the line, or 25 million total available and we've used the 16 million of it. So we have some available there as well, but we're not looking to increase that at all. Talking about the wells in general, zooming in a little bit here, We've got the Netherlands Sewell, what they put together for our east side PUD case curve. If you look at the map here on the right, these are the 4 wells that I mentioned are gassier. This is an upthrown horse block right here. That's the dividing line between east and west. As you can tell, most of our acreage sits on the east side. These wells here are what we consider to be in the corridor for our type curve. And so that's the difference between Netherlands Sewell's curve here, of the green line, and our curve is they took the average of most of these wells on this east side. No matter if it had a shorter length lateral or not, we're generally drilling 1 mile laterals. But when we were first learning to drill in the Caney, we were having some learning curves because it was different than drilling the Woodford wells. So we had some wells that were a little shorter length laterals. So now we're all drilling full length laterals. So what we did was we averaged out and normalized some of those shorter length laterals to come up with an average curve, type curve that we felt we could easily hit, which is just the average of these. You can see our IRRs, internal rates of return, making great wells on this type curve. So this year, when we first started drilling, our first 2 wells came in here. So versus Netherlands Sewell's just under 400 BOE a day IP assumption to our 480 BOE a day type curve assumption. The Barnes well came in around 940 BOE a day, and we're just over 600 BOE a day on the Barnes 8-4, the first 2 wells we drilled this year. So those are 2.4 and 1.5 times higher than the PUD assumed type curve on the 30-day IPs. So where we are now is we've also brought the Glen 16-2 well, was a well that we drilled about 4 years ago, which was the first well that was drilled with our new completion technique. And so that had an IP up here around where the 8-4 was. And the reason I mentioned that is, if you look at the estimated oil recovery here, the ultimate recovery, excuse me, that Netherlands Sewell has been doing over the years, you can see every year that it's been getting bigger and bigger and bigger. So our reservoir itself is performing well and performing better than Netherlands Sewell had originally anticipated. And so the estimated recoveries from each individual PUD case has been going up year by year. I put the Glen on here because the Glen has an EOR that's up around 765,000 BOEs. And that was the IP, again, with our new first generation of our new completion technique, I should say. So assuming we can drill more wells like the Barnes 8-4 this year and the Barnes 7-3, Netherlands Sewell should be moving that number up higher. So even though we're drilling locations that are in the proved category this year in general, because we're making wells that are better, and assuming these last wells come in higher than these type curves, they should be moving this up, and thus our proved reserves should be increasing further at the end of the year. How much it's going to go up, I'm not sure at this point. So the Emery well that just was announced on Monday, it's an IP of 10 because it was only on for about 10 days, was over 700 BOE a day. So that's our 3rd well this year, or 4th well with the new completion techniques that we've been doing in order to increase the productivity out here that's performing well. Looking at locations, we have 60 proved locations in this area. These are Netherlands Sewell's identified locations, the green in here. And this is obviously the majority of them are all in this corridor that we've been talking about. We also have 60 probable location and 65 possible locations, 17,000 acres total. It's virtually all held by production because, as I mentioned earlier, we originally drilled for the Woodford and then Exxon came in and drilled more Woodford wells. So all of our acreage was held by production. We actually hadn't drilled a well in 3 years. So during the downturn, all we did was cut costs and paid down the bank line. We went from a $30 million line down to paying it down to about 16 million, which is where we are right now. And because we was held by production, we didn't have to drill wells in order to hold production. So that gave us a lot of flexibility. So 185 total locations booked out here. All the infrastructure is in place because of the Woodford. So the oil out here gets trucked out. We get WTI pricing less about $1.85 in trucking. all of Exxon's production in the area gets trucked out as well. There aren't any lines that ain't close, but $1.85 differential to WTI is not bad. So that doesn't really make sense to lay any lines out here for that. The natural gas and natural gas liquids, Exxon is selling that for us. We get the same pricing that they get for when they sell theirs. We just pay them a gathering and a transfer, or a gathering fee and a compression fee for the gas. This is the area that Netherland, Sewell has evaluated. That's about 82% of our total acreage. And we don't have any wells that we've put in out here yet. But again, the lowest risk stuff is in this region here. And eventually, I think that drilling some wells out in this region on the west over here, hopefully you can see my pointer, will also be in the proved category. So we'll be adding some more locations, but right now it's called 55 locations after we drilled our well is proven from the Netherland Sewell report. All of our reserves are booked in the Caney. We had drilled some wells in the T-zone, which should be economic when gas prices are up in the region where they are now. They are a little bit gassier, probably because we're closer to the Woodford, which is down below the Sycamore here. And so you've had some gas that migrated up into T-zone. The Caney is actually quite self-sourced, other than the one area that I mentioned where we did have some Woodford that moved up into there on the west. So we have the T-zone that's potentially productive over our full acreage block as well. We know it's productive in certain areas because we've tested it. And we have the false Caney that's above us that looks good on logs, has not been tested, where we think it's on about a half our acreage that has perspective, or it is perspective. Now, we compared ourselves to other peers, the enterprise value versus the NAV using numbers from everyone's reserve report at the end of last year. We use Canadian comparisons because that way the reserve reports are done the same way. And as you can tell, the average company is trading at about 88% of their proved NAV. We're trading at 20%. And granted, we're about 10%. These numbers are about $3.44 Canadian, which is about 10% below where it's trading right now. But as you can tell, we should be 2 to 3 times higher in order to get into the lower tier of where it is, and almost 4 times higher, or actually 4 times higher to get up into where the average was trading. Same thing on the proved and probable reserve side of things. When we value ourselves that way, we're at about 14%, where the average is 60%, almost 60%. And if you're looking at us on a per share basis, on the proved basis, it's about $10 US a share, $13 Canadian. The proved probable is about almost $14 a share US, $18 on the Canadian side of things. And again, I was using a price of $3.44, and I think we're up around $3.75.80 today, roughly. So we said, okay, why are we trading this low? Granted, we hadn't drilled wells in 3 years, haven't done much, so word wasn't out there, but let's make sure that we're doing everything the right way. So operating netbacks, converting the Canadian numbers to US dollars, we have the best netbacks without hedging. Our G&A has been dropping every year. As we were mentioning earlier, we were cutting G&A. Our OPEX per barrel of oil equivalent is also on the low end of things. And these down here are actually natural gas producers. So on the oil producers, we're the lowest producer. And for everyone here in the US that's listening, don't be scared of $26. It includes royalties. So if you look on the US side of things, what we normally look at on the US side of things, our lifting costs are about $7.77. And second and I think third quarter was about the same. So everything looks like it's in place for what we need to have our stock valued a whole lot higher. So we said, okay, we need to increase our drilling. So this is the largest CapEx we've had in about 8 years. Luckily, we've made some good wells that have outperformed what we were expecting so far. And so our goal is to continue doing that, not increase debt drastically, and get the word out to maximize shareholder returns and just let the world know where we are. So for an illustrative example here, we said, okay, let's take an arbitrary number of, say we get the production up to 3,000 barrels of oil equivalent a day. What does it take to get there? And what does it take to hold it there? Now, this was put in place early this year when oil was 110 and 120. So it does use a $90 oil price, which is a little bit higher than where we are now, obviously. And again, it's just a theoretical side of things. It does use well cost of 6.9 million, which is where we've been drilling our wells for here. And we said, okay, so we're drilling 5 wells in 2022. If we drill 6 wells in 2023, all based on cash flow, by the way. And then in order to hold it there, we'd have to drill 1 well in 2024 and 3 wells in 2025. So about an average of 2 wells a year in order to hold production at 3,000 BOE a day, given these metrics here. What would that look like? So we said, okay, we'll assume that we pay down debt all the way, have our CapEx taken care of. Free cash flow after debt would be above 35 million a year. And so at 35 million a year, with 35 million shares outstanding, that's over $1 a share, or right around $1 a share US in free cash flow that we could generate. And keep in mind, 2 wells a year, hold it there, and we have 60 proven locations. So realistically, we will probably drill more wells than just one in 2024. We'll probably push production up higher, but we have a lot of cash flow where we can decide to either pay dividends, buy back stock, or do something else that's accretive for the company with acquiring something else going forward. So this brings me near the end of our presentation here. We can go to Q&A after this. But the bottom line is, in summary, we think we have an excellent asset, a lot of reserves, a lot of running room, making good wells here. We've got 3 wells now that have come on this year that have performed well. And the last one is obviously only 10 days in, but it's strong. And I would expect it to be well above our type curve when we get our 30-day IP number. The other 2 wells that we've drilled, the Brock 9-3 and the Glen well, the 16-3, both were drilled, fracture stimulated. Last announcement was we were drilling out plugs and we're expecting to flow back this week. And so in a couple, 3 weeks, we'll hopefully have stabilized rates of both of those that we'll be announcing, which hopefully increases our cash flow even further going forward and allows us to hit our year-end forecast. So that's it. We've got to, well, the other thing I should mention is we try to use good auditors. We have KPMG as auditors and NSAI, Netherlands Sewell, as our reservoir engineers. So we try to do everything the right way. And hopefully we're under promising and over delivering on our year. And with that, I think I can open it up to questions.
Okay, man, that's great. I posted one question to the chat board. Okay, for those of you on the line, if you have any questions, just post them directly to the chat box. And then I've got my chat box open, so I will see them. Just put them to everybody so that all the other guys can see them so they don't double up on the questions. The first thing, tell us a little bit about your new completion method. What makes it better? What do you think is the key there?
So when we first started looking at the Caney, we started fracture stimulating it similar to how we were fracture stimulating the Woodford wells, because we had drilled about 40 Woodford wells out there before we sold to Exxon. Mm-hmm. And we were kind of drilling 1 per section. But our fracture stimulation technique was basically a slick water going to a linear gel going to a crosslink. And so what that really does is creates big fractures that are going out quite a big distance. And so we switched to doing a high viscosity slick water fracture stimulation fluid. So with that, we bring everything in tighter to the wellbore and stimulate rock volume that's closer into the wellbore. So by being more of a slick water type fracture stimulation and using that high vis friction reducer, we're keeping it close into the wellbore and making better wells. What we've done since then is for every stage, because we're doing about 35 stages in a 1 mile lateral, we're actually ramping up. In the middle of the stage, we're pulling back down again, going back down to 0 proppant, and then ramping back up again. And so we're hoping that we're creating new fractures again, keeping it close into the wellbore. And then on top of that, we're actually also using diverter when the pressures aren't looking exactly like we want it to look, in order to create more fractures. So hopefully we're stimulating a lot of rock volume close into the wellbore And that's what's led to better and better wells that we've made out here.
Yeah, I always tell people horizontal drilling technology and then the improvements of being able to do these targeted fracks is probably one of the most incredible engineering feats of mankind. It sure
Yeah.
has opened up a lot of reserves. A lot of these questions that were emailed to me, I think you pretty much answered. So let me stick to the ones in the box and then I'll go back to these. What is the current number of shares outstanding? What's your ownership split between like management and large funds and stuff? And then and if you could talk about hedging too.
Yeah, happy to. So it's 35.6 million shares outstanding roughly. About half the shares are in large institutions and management board. So we've got about 16% that's management and board of directors.
Mhm.
We've got two other funds, one that owns just under 25% of us, both direct ownership and through what's called contracts. And another fund, they're out of the UK, another fund that owns about 12% of the company as well.
Okay. Do you have any plans to just sell the whole company? I mean, looking at your net asset value, I mean, I would think it'd be a very attractive takeover target, especially that's a pretty nice acreage block in there.
Yeah. So, I mean, let's put it this way. Through my entire career, everything that I have is always for sale for the right price. So we're not out marketing, obviously, to sell it because we think we have a lot of room to grow and we can show we can do this on our own. But you also get the best offers in when you don't need to sell. And you can do
that's true. Yeah. When everything's looking good, it's the best offer ever.
Exactly. So yeah, no, if someone makes an offer, we're obviously always consider it. You just have to. It just makes sense.
Yeah. Okay. It looks like you got a lot of running room just in the Caney and then those others with 185 locations. And when you say that in your reserve report, so Netherlands Sewell is only considering like what 50 or 60 of those locations to be PUDs?
Correct.
So by going out into those other sections and, just drilling like one well and all those boxes where it's, I guess the blue is the locations, you could add a lot more PUDs, right?
We can. We take, like I said, right now, we're going to be focusing, everyone can still see the screen here, on this corridor region.
Right.
Where there's a little bit more risk out here, a little less pressure. So we have to do a little bit different fracture stimulation technique out here, or try it, I should say, in order to make good, solid economic wells. These are outstanding wells in here. So and I think eventually we'll figure this out, but right now we've got so much running room in here that eventually we can poke one in out here and poke one in out here to try to expand that area a little bit more.
Yeah.
But for the near future, let's just get cash flow and harvest what we have here.
But are all those blocks are held by production?
Everything's held by production, even out here, and 99% of the acreage, I'll say.
So Exxon has deeper wells in some of those. Some of your
correct.
acreage.
When we sold them our Woodford, we had a Woodford well in every section out here. And
okay,
so that's, or virtually every section, I should say.
See. And for you guys on the line, that's a very good thing. And I can tell you, when I was at Hess, we were very attracted to properties like this that had a whole bunch of held by production acreage. So you didn't have that hanging over your head to go drill a bunch of wells.
Yeah, when we drilled the Woodford wells, we had 6 rigs running at the same time in order to make sure we were holding the acreage. So we didn't have that pressure in the Caney.
And this is the only acreage that the company owns right now, right?
Correct.
Okay. So you're not really out looking at anything else.
Yeah. Well, we are looking at other things, but if we had to use equity for it, it doesn't make sense because we're still so undervalued.
Right.
And we don't want to take on a ton of debt either. So we've got our eye on some other things, when everything turns around and we get up to different values. But right now, this is it.
Yeah. Well, I follow several small companies that when they finally start getting their stock price, it draws more attention. They've been doing deals like half debt and half equity, and that's helped their balance sheets very much. So let's see another one on here. Has the company considered entering into tax partnerships with investors to get funds for drilling so that you could, like drill some of this acreage on somebody else's dime and maybe do a third for a quarter deal where you're just getting carried or something?
Yeah, I mean, we looked at it through the downturn. We kind of looked at it a little bit,
yeah.
But now that we have the cash flow that's coming up, it
Yeah.
just makes more sense to just drill it up.
Yeah. Well, this is a very similar story to what, Hemisphere has done, which has been a great success for us. Is, they just get the production to a place where you're generating a ton of free cash flow, start paying dividends, and just keep adding a few more wells a year to hold it there. That's good. So anyway, treat it like a real long-term business,
Right.
Okay. On the 60 proved locations, what would your capital cost be to the well? So you gave us the well cost, what, just 6.9?
Yeah, it's about 6.9 million, correct.
Yeah. Are you having trouble getting tubulars and anything like that?
Yeah, it was tight this year. So we were very proactive in getting tubulars early, and we bought all of our strings of casing, etc., for these wells that we drilled 4 months before we moved a rig on, or 5
And
months.
how long does it take them to drill and complete the well?
So we always budget about 20 days, but we've been doing it as little as 14. So in that range, 14 to 18 has been kind of our average this year.
And okay, how deep is the Caney and how thick is the zone?
It's about 350 feet thick. It does vary a little bit, but what we're talking about here, where we're drilling, is in that range. And we down here, just for example, it's down at 14,000 feet. Up here, it's outcropped. Both the Woodford and the Caney actually outcrop here.
Oh, okay.
And in the region that we're drilling, we're down around 9 to 11,000 feet.
Oh, okay. Deeper than I thought. It must come out, it must outcrop pretty quick then.
It does. It really comes up fast in this region here. And notice that there's no wells out here.
Yeah. Well, what
So-
traps the oil and gas? Is it?
So there's a tight seal over it. So the Caney itself is actually self-sourced. And so you have some decent sized shale clays, or some clays, I should say, that are in layers in the Caney or above the Caney.
Mhm.
And so the division between some of these has a good caprock in it.
Good.
So
Good.
as much as a shale is always a caprock, or was considered a caprock, you need a different caprock on top of that still.
Yeah. Go back to your curves, your production curves, like how fast they decline there. So they're leveling off.
They do.
I mean, like all shale wells, they come on strong, pay out quickly. This is great, which makes it so much easier to reinvest that money again. But so let's say that Barnes 7-3 came in over 900 BOE per day, and it's going to be down to 400 after a year or so. And then after that, down to what, about 200?
Yeah, I would guess that they would kind of do something like this.
Yeah.
That's
So,
our best guess.
but then after they flatten out at 100, they can last a long time, right?
They really do. Yeah,
Yeah.
we expect this one to flatten out, a little bit higher than what the type curves are looking out here.
Yeah. I was on a webinar the other day, and somebody called it. They literally thought all these horizontal wells went to zero within like 3 years. They didn't realize there was any tail that went on.
Yeah. No,
And-
they're expecting, 20, 30, 40 years even.
Yeah. Well, what in your year-end reserve report last year, what did Netherlands Sewell use for their oil and gas prices?
It varied between 68 and 72. It was a forward curve, and then it was escalated at 2% a year.
Okay, so they're using the Canadian method.
They're using, yes, correct.
Oh, because you're listed on the TSX.
Exactly.
Exactly. Okay. So it's a little bit different than down here. So your oil and gas prices for this year end should not, well, the gas price should be quite a bit higher. Right.
Yeah. And everything's been higher this year, right? Over what was the estimates, right? If you look back, I'll go back a couple slides here. You can see here's the numbers on the far right side here. 2022, they were estimating at $73, 23 at 70, 24 at 68. 25 was just over 69, 26 was 70, 27 was 72, and then 2% escalation thereafter.
So are they looking at the strip, or how do they come up with this?
They in Canada, the large 3 engineering groups kind of come up with their own forecast price decks, and they kind of look at it and say the forward curve this year just doesn't look reasonable, and here's what we think it's going to do.
Yeah.
then so last year it just ended up being a lot more conservative than where the year is and even where we are right now.
Yeah,
Our forward curve doesn't look anything like that. So it'll be
well,
interesting to see what they do. But we've been consistent every year by always using Sproul's forward price decks.
yeah.
So that's how we keep our consistency up.
Yeah, and it's
versus
so
everyone else.
everybody's comparable. You're not using
Exactly.
different numbers for everybody's reserve
Correct.
report. The my 2 cents worth is I think what's going to happen in Europe this winter is going to drive these prices a heck of a lot higher.
I do too.
Okay, talk about market access. Do you have any takeaway capacity issues, oil, gas?
No, not at all.
And
Everything's trucked out. So,
yeah, and if Exxon's actually selling a lot of your production, I'm sure they got top priority over everybody else.
yeah, I mean, what moves my needle is oil, right? Natural
Right.
gas and NGLs is great, but most of what we do, even on our new wells especially, is 80% of it is coming on as oil.
Yeah.
So
yeah.
the 10% that's NGLs and natural gas, and you'll see, if you look historically, let's say at our financials, these numbers, the split between NGLs and gas changes because they decide that, look, they can get more money from natural gas, so they strip out a little bit less or strip out a little bit more if natural gas prices are higher out of the NGLs, right? And sell more of the natural gas. And when natural gas or NGLs are higher, then they use a little bit less of the natural gas or sell a little bit less of the natural gas and keep it more in the NGLs.
Yeah.
So, their marketing department is just a tiny bit larger than ours.
Oh, yeah. Oh,
so
yeah.
we assume that they're marketing and maximizing that value. That's one of the things we like about it.
Yeah. And this area has got plenty of infrastructure. I can tell you.
Yeah.
I was in Tulsa with Hess for a long time. So amazing area, but it's really nice that, I think Newfield discovered the stack or named it the stack.
Yep.
And I think Continental named it the scoop down there to the south, but
yeah, you can see on this map here, they kind of have the stack up here and then the scoop, and they used to have the merge in between. And I didn't highlight
merge.
that, but
yeah.
That's really what it is. The interesting part here, if you want to get a little bit more technical, is Arcani is unique here. It's the Merrimack technically, but it's not what everyone considers the Merrimack. Just because the Merrimack has more carbonate in it and it's more of a silty interval, whereas ours is truly a really high net to gross shale. So a lot of what they look at is partly it's sourced there, but partly it's sourced for the Woodford coming in.
Mm-hmm.
And they have these high perm streaks that they drill these horizontal wells into, which is why they sometimes have these really monster IPs, but they decline a lot faster too. So we did a decline comparison a couple of years ago. And I think I might have that slide in here somewhere. But we saw that in some of these other plays, let me flip through here, sorry, that we had about a 50% decline rate, whereas other people had more like a 70% or more decline rate. So yeah, here, first year decline rates, and this was from 2020 production data, oil and gas decline rates, we were, in the, call it 50% range on oil, BOEs, in that range, whereas others were in the 60s or higher.
Yeah. And in those, there's some real sweet spots in the Eagle Ford that's probably a lot better than that, but it's the Permian as well too. So it's not, that's one misconception. Everybody thinks these things are one big thing, one big field, and they're really not multiple fields.
Yeah.
So anyway, let's see. Oh, talk about the hedge book. Can you show a slide on the hedges?
Yeah. So the hedges, basically, here's what our hedging is right now. Our bank wants us to hedge about 75% of our proved developed producing based on their numbers of what they've looked at. And so what we started doing is, instead of doing just straight swaps, we started doing costless collars to give us more range, because we believe in the upside of this.
Yeah.
And one of the things we're looking at doing is, like, these wells that come on are zero hedged, right? And the bank isn't making us hedge them yet because they haven't evaluated them yet. So when we do our year-end reserve report and then our year-end redetermination with the bank, if we're down in the $15-16 million range for having net outstanding debt, I don't think we need to hedge 75% of all of our PDP. And so that's one of the things we're going to discuss with them is where we hopefully don't have to hedge those kind of numbers going forward. It's just more of our choice.
Yeah, because I've seen some people, especially on the gas, but you don't hedge any of your gas. It's just oil, right?
We haven't. We can do a little bit, but again, it's not a huge piece of our portfolio. So.
Well, I have a tie-in with a long-range weather forecast, and this guy's been pretty darn accurate. And he thinks we're going to have a very cold middle of December that could send gas prices a heck of a lot higher. So we'll see.
Yeah, if we see a big spike up, then we would definitely consider. But really, what it's always been is like the first 3 months of the year are high, and then it falls right back off again, right? So we'll see if the whole curve moves up a little further.
But Exxon's marketing all the gas and NGL. So is all their gas
Correct.
committed under pipelines? It's all committed already?
They find places for it. I don't know if it's all committed or what,
Okay,
but
okay.
our price does vary, so it's not like it's a fixed price that we're getting for.
Yeah. Yeah.
So,
One
our
year.
hedging would all be financial hedging on our own.
Yeah. 1 year when I was at Hess, they had a very cold December, January, and we sold gas into New York. And the gas was coming from like Louisiana. And we were able to get to the New York market for $60 an MCF.
Wow.
I actually thought I thought they put the decimal place in the wrong. When they brought the check in to show me, I said, that can't be right. I call our marketing guys and I said, how the hell did you get this? They said, yeah, just for a 1 week, we were able to get $60. I said, man,
Yeah, that's insane.
well, it's I believe that as we get more and more LNG export capacity, you will see gas move back toward, I don't know if it'll get there, but back toward 1/6 of the price of oil, which is how a lot of gas is priced on the international market. So anyway, gonna be
Yeah,
interesting.
that's how we come up with our BOEs as well, right?
Yeah,
We just use the 6 to 1.
Okay, talk about insider ownership. I think you already talked about ownership. Any interest in uplisting?
So we've looked at it. It's just doesn't
Very
make sense for
expensive.
the cost of it. Yeah, exactly. I mean, we have extra auditing costs, just with Sarbanes-Oxley, et cetera, because we don't have that when we're on the Canadian exchange. And then also we've looked at what it does to our DNO insurance, and just the difference between being on a Canadian exchange and the US exchange looks like it would add somewhere between $500,000 and $1 million a year to our DNO insurance, which is just insane.
Yeah.
So we're looking into that a little bit. If it's something that's reasonable and doesn't bump things up too much, then we would consider that further. But that's kind of where we are right now.
Okay. Let's see. Comes from easternmost wells. Well, so as you go east, you think the well performance is going to be less than what you got now?
Yeah, it's a little shallower. So we just get into
You don't have the
what
pressure.
we found is we need to be in the early wet gas window. And when you get over there, you're getting a little bit more into the oil window. And so you lose a little bit of energy.
Yeah.
And so we've got some ideas of how we can drill cheaper wells and stimulate it in a little different fashion where we think we may be able to make better and better wells out there. But again, not yet.
Yeah. One question, performance wells. Oh, it seems like Exxon would be a natural buyer of your company. Do you know their future plans for their program? And I can almost answer that by telling them you're way below their radar screen.
Yeah, exactly.
But they do have operations in the area, so they know what you're doing,
Yeah.
especially if they're marketing
Correct.
your production.
Yeah, and they're around us. I mean, they have some interest in some of these sections still, and some of the sections. I think they have a 1% interest in one of these wells that we just drilled.
Yeah.
So
What is
basically a 98 to 100% interest in most of these wells that we drilled?
Oh, the ones where you don't have 100%, they're the other owner most of the time.
Mostly, yeah. There's some
Got
small
a few
single ones in
mineral
there,
owners or
but
something.
yeah.
And okay, what's your revenue interest in these things?
So we generally, it varies from section to section, obviously, but we're about 22 to 23% royalties.
Royalty. Okay. What were your net back prices on gas and NGLs in the third quarter?
I don't remember off the top of my head. I don't know, Gary, you probably don't have that either off the top of your head.
I mean, just our pricing?
Yeah, just like what was your net price out there? Because
okay.
you don't have any of it hedged, so it's probably pretty much the market price up there.
Yeah, I know we had
So
I think we had an $11 or $12 month.
Yeah, our average gas price for the quarter was $10.24 per MCF, and our NGL
Wow.
price was $35.
And are you seeing something close to that in Q4?
We won't know for a couple months.
Yeah,
So
those
literally-
lag a little bit because of the Exxon, so we won't know. But I mean, I don't think they're going to go. They might go down a little bit, but we don't know the answer to that. Yes.
Okay, but so when you get to the end of the quarter, I mean, how do you do the accrual on that? You kind of got to guess.
Yeah, the December's will be an accrual generally,
Yeah.
or the final month.
Keep
of
in
the
mind our
quarter will be
revenue
an
is like 85%, 90% oil. So I mean, it's not a significant
It's not that significant anyway.
accrual, but we do accrue. Yeah.
Yeah. Well, I can tell you a long story. When we shut down Hess's Tulsa office and moved down there, I was over all of accounting, so I had the revenue sections, and we had like 80% turnover. It went, and we had 80,000 wells, and so it was pure stinking guesswork for the next year every month. what on the outside operated wells, especially, just a pure wild ass guess. It was surprising how close we came, though. It was amazing. So who knows? Let me go through some of these other questions. So 108. Are you able to talk about what you think your exit rate's going to be this year?
So
go ahead.
we forecasted 2,700 BOE a day.
Okay.
But if you look at it, we were 1,700 BOE a day third quarter, and so we just brought on a well at 700 BOE a day.
Yeah.
And so it just depends on how these next wells come in, right? So where is it
coming at that? You're going to be much higher, but
right, exactly. So at this stage, we don't know where those next two wells are going to be either. We're hoping that they're up in this range here, but all my forecasts and everything else are all based on this blue curve, right? All of those theoretical forecasts that we put together on the 3,000 BOE a day number, holding it flat, they're all based on IPs, under 500 BOE a day.
okay. Let me ask you this. So you don't have an operator rig tied up?
No, we do not. We're not drilling continuously.
So once you sit down and do your CapEx program for next year, what are you going to do? Are you going to drill like 2 or 3 wells at a time? Then you get those completed. Then a few months later, drill
for
another
instance,
package.
we bought most of the casing for like 3 wells in a row. So that we'll be drilling in first quarter. We haven't, just to be clear, that's what management wants to do. We haven't gotten board approval to what our plan is going forward.
Yeah.
And really we couldn't until we get all 3 of these wells on, and the first of which, we just announced on Monday. So once we get the production rates and we get the IPs from these next wells, then we have a pretty good feel for what it's going to look like, and we can forecast out. Again, we're not raising equity. We don't want to go use a bunch of debt, so we want to see what our cash flow really is going forward to utilize that to drill more wells.
Yeah, and the winter can be pretty bad in Oklahoma, so it might be cheaper to wait until you get past the really bad weather too to start another package of wells. So anyway,
yeah, you can have flooding and things like that. We're in a pretty good location, so we've only had flooding issues. I think in the 15 years once that really was an impact.
Yeah. Okay, man, that's good stuff. I mean, and you guys with all of it being held by production, you got a lot of flexibility. So,
right. And
yeah.
And one other thing that I didn't mention, just on the ops side of things, this property doesn't produce a lot of water. So the caney that we're producing in, a lot of these operators have to dispose of a lot of production or a lot of water that's produced.
Right.
And in our case, when we're making, let's say, obviously we're flowing back frac fluid, we're having to get rid of that. But when baseline production is hit after, let's say, 2-3 months, there's not a whole lot of water coming out. When we were 1,300 BOE a day of production, we only had 100 barrels a day of water that we were disposing of from the entire field.
Yeah.
And so that's why our costs are so low as well on the OpEx side of things. We don't have the headaches that a lot of others do have. And again, that goes back to that net to gross shale being so high.
Yeah, that's good. And with this increased production you showed operating expenses of $777 per BOE, right. But obviously with these wells coming on, adding maybe another 1,000 barrels a day of production, your OpEx could go down below $6, right?
Yeah, I don't know how far it's going to go down because you do have some price escalation that's going on
Yeah,
in
yeah.
the industry in general, right? So we got to offset that. But yeah, our OpEx should be going down, barring price increases from services that we need. But we do have a number of fixed costs that just get spread out much better with the higher BOE numbers.
So when you complete these wells, they flow on their own for a while?
They do. We produce everything on gas lift out here.
Okay.
So we generally flow them for 2 to 4 weeks, and then we'll throw tubing and gas lift on. They'll flow a little bit longer on their own, and then we start using gas lift. It just depends on the well. The newer fracture stimulation techniques have allowed us to flow much longer than our previous ones were.
Yeah, that's good. Lower OpEx. What are your current number of operated wells?
We're at what are we, 18?
18, and they're all in that one area. So you don't have real high pumpers fees or anything like that.
No.
And you got good access to electricity and everything.
Well, we don't need any electricity out here. Everything is, because it's gas lift.
Oh, okay.
We burn our own produced gas in order to run the compressors to run the gas lift.
Okay, cool. That's cool. Let's see.
And this is clarify, it's 18 before these new wells coming on.
Okay,
Oh,
so
right.
you're gonna be 21 or so. And then how many total employees does the company have?
9.
Oh, 9. Okay, and
Yeah, we run pretty
you're-
lean.
you guys are located in California, correct?
Yes, Gary and I are, and some of our accounting staff, and then we have our engineer and ops guys are in Oklahoma.
And are the ops guy, a lot of those ops guys just contract people?
Yeah, I mean, they're semi-employees basically.
Yeah,
2 of
right,
them
I
are,
know.
and the rest are contract.
Yeah, we had a lot of
So-
semi-employees, even the ones that were on payroll. Some were just part-time employees.
Yeah, so
You know, how
we're
that-
more like on the contract side of things. They're almost more full-time on us. That's 2 of the guys, and that's what I consider in the employees as well.
Yeah, one of the questions I hear that was emailed to me, some have questioned the Caney Shale being a true shale, but that sounds like you've proved that it is even better than some of the other shales. But your well results tell a different story, obviously. Can you go on a map? Okay, which already have answered this, that how big is the sweet spot? So right now, when you're saying there's 50 or 60 wells in what you would call kind of the tier 1 sweet spot of that field, right?
Yep.
Okay,
Correct.
so that's a lot of running around. If you're only drilling 6 or 7, wells a year,
Right.
that's interesting. And obviously, if the oil price would go firmly over $100 a barrel, you could add more wells every year just to get going.
Yeah, absolutely. And as
And-
as we drill more wells, it's obvious. I mean, that theoretical case, generates a whole lot of cash flow that we could keep building on that and easily get up about 3,000 BOE a day. So that was just literally a theoretical. Just I grabbed a number out of thin air and said, okay, if we did this, let's just show how much cash we can generate, even if we just held it there.
But no,
So-
there's no facilities issue or pipeline connection issue. So there's really
No.
nothing keeping you from just ramping up production rapidly. I mean, if you just wanted to really get after it and
Correct.
go to a
And,
continuous drilling program and drill out a section at a time, you could just keep
Right.
adding more and more production. Okay.
Yeah, and the 6.9 million includes our facilities, the tanks that we put in for each new well as well. It's not just the
Okay,
well cost. So
okay.
it's an
Oh,
all-in cost.
Okay. Yeah. Like on each well, you have to put a tank battery.
Yeah, we that's what we've been doing when we start,
Okay.
drilling more wells closer together with the same mineral owners, then we can start combining some things. But right now we've been putting in tanks per well.
Yeah.
So
There's
that'll reduce some costs as well.
Is the Glen 16-3H, is that the newest well?
That's one of the ones that's coming on soon here. Yeah.
Okay.
So
One question is, you had better oil and gas shows on the Glen 16-3H, which can indicate higher productivity. Do you expect this well to be the best you've drilled to date? Who knows, right?
so yeah, so I mean it's a bit subjective. I mean, all these wells were all in the same kind of what I'll say band of having higher gas shows or lower gas shows.
Okay.
The Emery was actually on the lower end of it. But it had some other ratios that made it look really good as well. But on total gas, it was a little on the lower end of the band. And obviously with the 700 BOE a day well here, that shows the variability in what you're looking at. So like it's never a determining factor. What I like to say is everything we've seen and what we've done so far is what we need to do to make good wells. Now we just, wait and see what the wells will actually do.
If you like the 5 most recent wells, including these 3 that are just being completed now, based on what you know now and at current price, let's say a $75 oil price, how long do those take to pay out?
Well, do I have a well that's like the 8-4 or do I have a well that's like the 7-3?
Yeah, I mean,
Right.
kind of as a group, what would be the average?
I mean, this
Yeah.
was like, I think this was 4 months or something.
Oh, wow.
And that was at 100, but that was at $100 oil price, call it.
And a lower
So,
cost too than now.
Yeah, good point. So we're probably in the, call it 7 to 9 months range.
Yeah.
If I had to guess, and if assuming we're making wells up in this range in here.
Man, it's good stuff. Guys, I can tell you, and I'm old, so when I was at Hess, we were happy if anything paid out in 3 years. And you were happy offshore if those projects paid out in like 8 years.
Yeah.
They may be huge reserves, but it takes so long to get your money back from when you first started spending it. Anyway, with the success, okay, and obviously you do expect to see a big increase in your proved reserves, PDP and PUDs, I would think, just from higher prices, the success of these new wells, right?
Yeah, value definitely on the higher. I would assume the prices are going to be higher than they were this year.
Yeah, well, we were talking.
Then also, I think that our proved number on a BOE basis should be going up. I just don't know how much.
Yeah,
Just based on what the Glen was doing and what these wells should end up doing. That's got to bring the average that they're looking at up from this 555. It's just a matter of how much credit do they give us at this point in time.
well, I think, and we were talking about this at our luncheon on Monday with Hemisphere, is that you've got high quality companies with super strong balance sheets that are only trading for like 3 times cash flow.
Right.
It's insane. When I was at Hess, we had the last like 5 years I was at Hess, I had a team of like 8 MBAs, and we were just based on public information. We were looking for takeover targets. And to get on that list as a potential takeover target, the threshold was 6 times operating cash flow. And then, depending on how much, acres like this that they had, a whole bunch of running room, that's what really interested us in a lot of companies. But to see, Continental and, some of these great companies that are just super strong with lots of running room, trading for just 3, 4, 5 times cash flow. It's insane. So here's what I think is going to happen, guys. This is my theory. I think we're going to get, because of how the energy sector has just crushed the rest of the S&P 500 sectors, you're going to get a lot of money managers literally that are forced to rebalance their profiles and consider adding more energy. I don't know how, their investors are going to say, wait a minute, we're ignoring the most profitable sector in the entire market. They're going to be forced to rebalance their portfolios and add at least some energy. Now, it'll go to the larger companies first, but then what's going to help, like you guys at Hemisphere and In Play, they're trading for 3 times, cash flow or less. They're going to then start looking at your numbers and say, well, wait a minute, I paid 6 or 7, 8 times cash flow for this one, but look at these that are selling for just 3 times cash flow. Then when the analysts get in and start looking at these companies, especially guys that have analysts that have never looked at how profitable this sector can be when oil and gas prices are this high, they're gonna have some eye-opening experiences, I can tell you. So
yeah, I think the generalists, like you said, the generalists are not in the market yet, and it's because the downturn was so long, and everyone got out of it, and everyone ignored energy, and that was the bad place to be. Like you said, it's going to take the generalists to come back into the market, and they're not there yet. So
yeah. Well, I got a report by one guy, and this guy's pretty smart, knows the market, and he says his prediction is that the tech sector will go to half the percentage of the market that it is now, and a lot of that money will roll into the energy sector. It's just going to be this big paradigm shift that, hey, we're not all going to be driving EVs before 2030, and we're still going to need a whole bunch of oil and gas. And I think that's going to be an eye opener. So we'll see. Let's see, you haven't released your budget yet. You have 60 of the 85 booked. Yeah, you're not going to get the 185 locations put into your PUDs for a long time unless you go out and do all that step out drilling.
Yeah, we're not going to. Yeah, and we're not drilling that anytime.
And you're not going to do it anyway. So
We will, I mean, eventually we'll go test out there, but it's not going to be in the first half of next year, that's for sure.
Yeah, somebody asked here, please remind, what did Exxon pay you for the Woodford Shale?
147 million.
Okay, and at that time, like that all went to pay off debt stuff.
We actually, in between there, we went to, we were doing shale gas in Europe. We were just 10 years early. We had about 5 million acres leased in Europe and then had to get out because Europe was so anti-oil and gas.
Yeah.
Were
you guys actually in Poland?
Yeah, we drilled 5 wells in Poland.
And they're sitting on a ton of reserves, aren't they?
Yeah, I mean, what we found was a little deep and expensive to get is what the reality is. But at the prices that they're getting now, yeah, no problem whatsoever. We were also in Germany and Spain and had applications in a bunch of other areas. So we did spend quite a bit of money over in Europe. But like I said, we were about 10 years early and no one wanted us there at the time. So it was a big fight.
Well, I could tell you that the fear of climate change has been so much sold to the younger people. It's going to be very hard to get them to move away from that climate change stuff. So who knows? What do you see as your biggest risk of your current picture? Commodity prices.
I mean, for the near future, as long as oil stays. I mean, when we were looking at starting to do this, we were looking at $65 oil prices when we decided what our plan was for 2022. Okay. So, that's okay. It's just going to be how many more reserves can we cram in here that we can make work. So yeah. I'm comfortable with what we're doing.
And you did talk about the hedging policy, but now you're looking at using more and more costless collars, correct?
Yeah, that's all we've been doing lately.
Yeah, good idea. I don't know if you've ever heard of these guys, but we're connected with a firm called Aegis, AEGIS.
Yeah, we've been talking to them as well.
Okay, they're very, very good, and they've.
I agree.
Those guys do, and they do these webinars all the time. Mm-hmm. I'll send you links to them if I get it, or yeah, if once you get on your EPG membership, it's mentioned all the time when they have their next one come out. And Matt Marshall over there is like super sharp guy on the market.
Yeah, I've been on I think every webinar they've had for the last year.
Yeah, very good, very good, very sharp.
I agree. I like those guys.
Yeah, well, I was in one of our members from New York. He's a big wheel Wall Street guy. And he comes to Houston every year and puts together this roundtable discussion. And Matt was invited this year. And I can tell you that the people on the side of the table, the non-industry people, were kind of blown away by the potential of the side of the hedging stuff too. Who knows? But and I think you don't have any near-term debt problems. You're well within your covenants and all that. Yeah. Bankers are happy. They want to give you more money, not less, right?
I would assume so. Yep.
And when do you review your credit line again?
It'll be for the year-end report, so it'll be in March, April.
Okay, good. So, all right. Well, you have reported third quarter results, correct?
Correct.
Okay. So what we'll do, I will assign one of my really sharp MBA guys, and he's going to work up a profile in you. And I'll work up a forecast model. We'll put that together and we'll publish a profile that'll go to all of our global membership. So that goes to 400 or 500 people. And even though they swear on a stack of Bibles, they're not going to share it. They do. So probably to 1,000 people. Anyway, and then we've recorded this and we will send out the link later today. So thanks again for doing this. And, once you get your year-end numbers in your reserve report, maybe we could do this again. And if you're ever wanting to host a luncheon for us in Houston, we're back up and doing that again. We're finally past all the pandemic nonsense. So occasionally that helps you get in front of some of our key members here in the Houston area.
All right. That sounds good. I appreciate your time and everyone else's time who's on the call.
Okay. Thanks a lot for doing this. And we're going to be watching you from now on.